President Trump isn't even in the Oval Office again, and yet he's already causing tweet storms over his proposed tariff policies. We're going to talk about the policies, what it could mean for you, and how can it impact your investing journey, all this and more. My name is Daniel. You're watching Unrivaled Investing. Let's discuss what President Trump has proposed. Just a few days ago, talking about how on January 20th, as one of my many first executive orders, I will sign all necessary documents to charge Mexico and Canada a 25% tariff on all products coming into the United States. That is a hefty increase in terms of costs that consumers could see. He's not done yet. He's talking about tariffs as well for China, an additional 10% because of the massive amount of drugs, in particular fentanyl, being sent to the United States because of China. He's, attributing it to China. So you're talking about the caravans of illegal immigrants via Mexico, open borders in Canada, and illegal drugs from China. And so the immediate impact that folks are saying, well, wait a second, couldn't you see hundreds of thousands of U.S. jobs lost if you indeed have a steep 25% tariff, on Mexican goods that are being imported? And I think it's important to understand, this is a negotiation tactic that he's taking, where he's saying, look, the default, if you don't come to the table, is going to be serious tariffs, and we will endure pain. But I'm expecting you to come to the table. I'm expecting this to be a conversation. So I'm going to, signal very clearly what I'm expecting, what needs to be addressed, and what the penalties will be if we can't come to an agreement. But people come to the table. And just, a few minutes ago, he's talking about how the new president of Mexico, Claudia Sheinbaum Pardo, is saying, look, she's agreed to stop migration through Mexico, effectively closing our southern border. It was a very productive conversation. He's wrote, thank you. This go a long way towards stopping the illegal invasion of the United States. This type of language makes me think, yeah, that 25% tariff on Mexican goods, not likely to see it. I don't think you're going to see it. I think this is a negotiation tactic. Get the leaders to the table and say, hey, what are you going to do to make sure that my problems are being addressed? That's the first point. That said, you still have folks saying, well, wait a second, couldn't you have increasing, maybe he still does a 5% increase or a 10% increase. Couldn't you still see sizable increases on the goods being imported? One of which is, pickup trucks, where something like 88% of the pickup trucks sold in the United States is actually assembled or produced in Mexico. And some are saying, wait a second, this could cause a $3,000 increase on pickup trucks. I think it is important to monitor broadly the potential impact on tariffs. And I do think net by itself, tariffs could cause inflation. And that, especially when you throw around like 25% type of figures. But once again, I think it's a starting position. I think it's a negotiation tactic. And I think critically, and this is something a lot of people missed, particularly with this last election, was a lot of people were just looking at the CNNs, the Drudge Report, the various different media sources, Fox and Friends, and they were all sort of suggesting, hey, Trump, Kamala, neck and neck. But the betting markets consistently said no, Trump was likely to win. So I think prudent, smart investors have recognized that the legacy media establishments are largely broken. And what's better is to find examples where there's money on the line, because then you have some sort of skin in the game and you might have some sort of edge in terms of what the data is saying, what the markets are signaling. And this is something, it is important to see, perhaps what are the markets suggesting about inflation in terms of the betting markets. Right now, you're not really seeing it saying, hey, there's going to be at least 4 or 5% inflation. That said, it has been ticking up slightly, but it's not huge. They're saying a 38% chance of at least 3% inflation. This is something to watch, though, I think, for investors to be mindful of, saying only 13%, saying at least 5%. So I would say the markets are currently saying, yeah, it's unlikely to directly go through. Another concern is, well, wouldn't this actually really hurt the U.S. economy, because a lot of goods are still being exported to Mexico, China, Canada? You had the president, this was prior to Trump's recent post, talking about retaliatory tariffs in response to Trump's threat if the U.S. were to go through with it. Personally, once again, I'm less concerned about that, because when you look at the net effect, you can see the amount of imports, that's this total amount here from Mexico versus the exports to Mexico. So that leaves a sizable gap, and that sizable gap is the trade deficit with Mexico. So net, obviously the US has more leverage, and that's the same with Canada. That's the same with China as well. So overall, I'm really not worried about the retaliatory measures. That said, this type of positioning, this type of conversations, you will see changes in, you will see volatility in orders, because American companies are going to be like, oh my goodness, inventory costs are about to jump, 25%. I need to load up on my goods now. Or in the case of China, the goods might go up by 10%. So let me, stock up my inventory now. So that way, it's less painful next year. You're going to have that volatility. I think that's just sort of a cost of business that you just have to accept. There's volatility in life. So what are my thoughts on tariffs, or more particularly, Donald Trump, his policies on the economy, where the markets going forward, that sort of thought process. First of all, as always, this is not financial advice. And also, quick plug, just last week, Santosh upgraded to a premium membership of Unrivaled Investing, emailed me the following. This is a direct quote. I really enjoy following your letters and your investing journey. This was one of the best investment decisions I've ever made. Can't thank you enough. If you're looking for compelling ideas, come check out Unrivaled Investing. By the way, the prices are going up at the end of this month, so now is the time to lock in the favorable rates. I think it's super important to reflect on and understand that President Trump does keep his fingers on the pulse in terms of the market. And this is favorable. I'd argue this is favorable for investors. This is favorable for consumers. And this is causing, some folks to say, like one noted mega bull, Jeremy Siegel, to say Trump is the most pro-stock market president in history. The reason why I think it's important to keep your fingers on the pulse is because the opposite is a president that completely ignores market signals. And you could look at like President Hoover, as that would be like an extreme example, where you had the economy like imploding. You had the stock market imploding, and it was sort of like, well, we need to just do more of the same. And partly that's because the Treasury advisor that he had, and Treasury Secretary Mellon at the time, was sort of like, tough it out. This is how you cleanse the system. And it was more of the same. And that's part of the reason why the stock market dropped by 90% during the Great Depression. And so it's important to recognize that leadership, being aware of certain dynamics and what are they rooting for? What do they care about? What are their mental processes? So seeing Donald Trump historically tweet about the stock market making new highs, that does mean that he wants the underlying drivers of the economy, which is ultimately, there's really only, a few things that drive the stock market. You're talking about underlying fundamentals, which is sales and profits. And you're talking about the valuation multiple. So he's saying, hey, I want ideally both to go up. That's what he's rooting for. So as an investor, you're hoping that he succeeds. I would say his nomination of Bessent, Treasury, potentially Scott Bessent, Treasury Secretary, potential Scott Bessent, I think is a great nomination. And this is part of the reason why the markets broadly responded favorably to his nomination. Treasury markets also rallied because they're saying, hey, he might take the U.S. deficit seriously. He might take the U.S. debt problem seriously. For context, Scott Bessent previously worked with George Soros and Stanley Druckenmiller. These are titans of the hedge fund industry. He knows how markets operate. He previously ran a hedge fund himself. He knows if something starts going off the rails, he could, step in and say, well, wait a second. This is the policies that are working. These are the policies that aren't working. So I'd say this is a very favorable nomination. And just, I think earlier this week, he was talking about how, look, President Trump has some very good ideas, but I guarantee you the last thing he wants is to cause inflation. So all this sort of legacy media talking about like, oh my goodness, Donald Trump's going to cause like hyperinflation. That's not the case. I at least that's not what the betting markets are saying. And that's also not what, very prudent leadership, future Treasury Secretary, is saying. Look, this is very top of mind. He recognizes that inflation could hurt the valuation of the market, could hurt the underlying fundamentals of the market. Now, what is Scott Bessent? What's his approach? What is he targeting? And he's talking about a 3-arrow approach, or 3-3-3, 3-arrow economic policy. One of which is to cut the budget deficit to 3% of gross domestic product by 2028. The other is driving 3% GDP growth through deregulation and producing an additional 3 million barrels of oil, or its equivalent a day. So that increases the supply of oil. I think this is actually super interesting for investors to reflect on, which is that no one knows exactly how the macro is going to play out. There's always could be an external event that happens that no one's mindful of, that plays out, that's just a complete shock. A shock to the system, just the way, if you were investing in mid 2019, well, what you had on your bingo card for 2020 ultimately was very different in terms of, broad macro effects, in terms of what's actually happening. That said, there are a lot of interesting pieces here, because President Trump has talked about, and working with Elon Musk, the Doge, the government efficiency initiatives, and talking about significant scaling back of fiscal expenditures. So you could have a situation where you have an inflationary tariff that does go through. Maybe it's not, a full 25%. Maybe it's a 5%. Maybe it's a 10%. Maybe for China, it's only 5 versus the 10% that's being tossed around. You could have a dynamic like that could be inflationary, but then you offset it with a deflationary thing like reducing the amount that the government's spending. Pulling back effectively the amount of money that's going into the system. So by managing these different levers, you could have a situation where, inflation doesn't go that crazy, doesn't, spike higher, even if you do have significant tariffs. So I think you have the environment, you have the setup where you could see significant changes in the years ahead. And I think they're targeting, I think this 3-hour approach is actually very sensible. This should be the North Star. This should be the guiding star of, let's get our spending back in order. It shouldn't be 6%. It should be 3%. Let's get economic growth through deregulation. Let's get economic growth picking up. Like, economic growth should be the priority, no matter what your political affiliation. So saying, hey, we're going to get 3% growth, that's what we're targeting. I think you judge them by that. If they're not getting, 3% growth in the coming years, say, okay, you clearly messed up, or something, there was an external shock that you didn't react well to. So I think that's important to reflect on. And also saying, look, we're trying to produce more barrels of oil. Smart minds can disagree on this. Some people might say, Charlie Munger used to talk about, hey, let other nations produce their barrels, let the U.S. save it as sort of a strategic reserve over time. There's different perspectives on that. But he's effectively saying, look, if you produce more barrels, that's also another deflationary initiative. So that gives you more bargaining power to actually implement those tariffs if you wanted to. Which effectively, if you have more oil coming into market, deflationary, tariffs, inflationary, that way maybe you keep prices stable. Maybe you have a dynamic like that. So recognizing how volatile, how uncertain macro can be, I think it is important to recognize, and this is how I'm personally investing, that my investment checklist doesn't change. I'm still focused on some very simple basics, like, is management aligned? I love finding, founder owners that own 30% of the company, and, they have a very clear vision for why the business could be multiples the size in the future. And the goal is to still buy at a compelling valuation. Now, so this checklist, I'd argue, it really hasn't changed. Like, that's my personal North Star, the founder-led, reasonable valuation, obvious growth potential. And I've called out a few examples on this channel already. I mean, most recently, I did a video on C. Before that, I did, AppLovin. I own, full disclosure, I own positions in both stocks. So you can check out those videos if you're interested, both of which, founder-led type of examples. And I think the main aspect that I am aware of that sort of is getting bumped up because of the increased noise that I just expect with the Trump presidency. You're going to have this, I think, is this perspective that you will have more currency volatility. So just being mindful of, okay, if the US, let's say US dollar were to rally versus the Canadian dollar, Brazilian real, those types of things, Mexican peso, how will that impact my underlying holdings? So that is something to be mindful of. That you're going to have more volatility, especially if you have, a strengthening of the US dollar. That does make it sort of harder for the US economy at times. But it's, anywho, there's different dynamics here for investors to consider. I think it's super important to recognize that being able to accurately predict the macro, where you're saying, oh, this is definitively going to happen, that's super hard. And most investors do not get it. And so sticking to a game that you can win, that my approach isn't changing. Founder-led, obvious growth potential. And so I hope this video talking about the potential ramifications of President Trump's tariffs have been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.